All right, quick favor before we dive in. If you care about understanding markets before they hit the headlines, stay with me for the next few minutes, because something just happened, and it happened fast. In less than 24 hours, silver dropped about 21.5%. We're talking roughly $120 an ounce down to around 97. That single move erased more than $1.4 trillion in paper value almost overnight. And here's the key thing. You're probably being told this was panic, or fear, or a sudden collapse in demand. That's not what this was. Both futures positioning data and exchange margin updates confirmed the same thing at the same time. This was forced deleveraging, not choice, not emotion. Mechanics. Stay with me, because I'm going to show you what actually just broke, how to recognize it next time, and why moments like this often matter more than the rally that came before. Before I explain what caused this, let me teach you something most people never really internalize about markets. Price doesn't move just because opinions change. Price moves because positioning changes. And here's what I mean by that. Think of leverage like stacking furniture on a moving truck. As long as the road is smooth, you can stack it high. You can keep adding more. But hit one pothole, and suddenly you're throwing couches off the back just to keep the truck upright. That's what leveraged futures markets are. When prices go vertical, leverage quietly piles up underneath. You don't see it, but it's there. And when the move finally stalls, the selling isn't strategic. It's mechanical. That's why you'll see massive moves where fundamentals didn't change at all. The company's still the same. The commodity's still the same. But the price just dropped 30%. Understanding that difference is how you stop reacting emotionally and start reading the tape. If this is making sense, drop a comment below and let me know what you're watching right now. Now here's what's actually happening. Let me break down the sequence because this matters. Silver went parabolic, not up 10%, not up 20%. It went vertical, and when that happens, margin requirements rise and volatility models tighten risk across clearing firms. So when silver pulled back even slightly, accounts that were over-levered got hit with margin calls. That forces selling. That selling pushes price lower, which triggers more margin calls, which forces more selling. You see how this works? It's a cascade. Here's what's wild about this. At a certain point, it no longer matters who wants to sell. Everyone sells because they have to. Futures contracts liquidate automatically. Stops get blown through. Liquidity thins, and price gaps. Secondary confirmation showed up immediately in open interest collapsing, not rising. That tells you this wasn't new short conviction. It wasn't some hedge fund saying, hey, I think silver's going down, let me build a short position. No, this was longs being wiped out. And when you combine that with physical premiums in Asia holding firm instead of collapsing, you get convergence. Paper pressure down, physical demand steady. That's the tell. Because if this was real, fundamental demand destruction, you'd see physical premiums crater everywhere. But they didn't. They held. That divergence tells you something important. But here's the part that should make you nervous if you're not paying attention. This phase feels chaotic, but it's actually the market resetting itself for price discovery. What does that mean? It means all that artificial leverage that pushed price up faster than fundamentals justified, it's getting wrung out. And once it's gone, once that forced selling is done, price can actually move based on real supply and demand again, not on who's got the biggest margin call, not on whose position just got liquidated, but on actual buyers and actual sellers making actual decisions. Now let me show you what very few people are talking about. When you look at the intraday volatility patterns, something interesting happened. The initial drop was violent, yes, but the recovery attempts kept getting sold into. That's not normal profit taking. That's liquidation still in process. You can tell because the bounces were shallow and got rejected fast. No follow-through, no conviction. Just mechanical covering and then more selling. That pattern continues until it doesn't. And when it stops, when those bounces finally hold, that's your signal that the forced selling phase is ending. This is the exact same playbook we've seen before. In 2008, silver collapsed as leverage unwound, right before the monetary response changed everything. I remember watching that. Silver went from near $20 down to under $9 in a matter of months. It felt like the world was ending. And you know what happened next? The Fed stepped in, massive stimulus, and silver went on to nearly $50 by 2011. Same pattern. In 2011, after a parabolic run, silver crashed hard, not because demand vanished, but because futures leverage broke. It dropped from $49 to $26 in 4 days. 4 days. And in March 2020, during the liquidity panic, precious metals sold off violently, even as long-term fundamentals were strengthening. Gold dropped, silver dropped harder. Everything was being sold to raise cash. Every time this has happened, the move felt like the end. And every time, when you zoom out, it marked a transition, not a conclusion. The larger story is that extreme volatility compresses future outcomes. It doesn't end them. History doesn't repeat perfectly, but it absolutely rhymes when leverage is involved. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could silver keep falling? Of course. Could this be signaling a broader risk-off move across commodities? Yes. Could we see $90? Could we see 85? It's possible. And let me be honest. Claims about permanent manipulation or secret suppression don't help you make decisions. I've heard them all. The banks are suppressing it. There's a conspiracy. Maybe. Maybe not. Here's the thing. It doesn't actually matter whether there's some coordinated effort or not. Markets can be unfair and still be readable. The mechanics are what matter. The only thing you control is your time frame and your risk. Instead of arguing about motives, focus on signals. Focus on structure. Focus on whether forced selling is ending or accelerating. That's what you can actually observe and act on. There are probably 3 types of people watching this right now. First, there's you if you sold earlier, and you're wondering if you dodged a bullet or missed something. Let me say this clearly. You didn't miss clarity. You preserved optionality. Your job now is patience. Wait for confirmation. Wait for the market to show you what's next. Don't rush back in just because you feel like you should be doing something. Sometimes the best trade is no trade. Second, there's you if you're holding and feeling that pit in your stomach. That's human. I get it. But ask yourself one question. Did your thesis depend on silver never dropping 20% in a day? Or did it depend on multi-year fundamentals? Because those didn't change overnight. The supply deficit is still there. The industrial demand is still there. The monetary backdrop is still there. If your thesis was longer term, one day of forced selling doesn't invalidate it. It tests it, sure, but it doesn't break it. Your risk tolerance might have changed, and that's fine. But don't confuse a mechanical move with a fundamental shift. And third, there's you if you're itching to buy the dip right now. I get it. 20% off feels like a gift. Just remember, forced selling ends before sustainable buying begins. Let the market prove stability first. Wait for that volatility to contract. Wait for those intraday swings to narrow. Wait for price to hold a level for more than an hour without getting slammed. The universal principle here is simple. Your decision should match your horizon, not your emotions. So here's what I want you to answer in the comments. Which one are you? Are you sitting in cash waiting? Are you holding through this? Or are you looking to add? Be honest. I read every comment. So here's where I stand. I'm not panicking and I'm not rushing in. I'm watching. Let me tell you what I'm personally watching. First, I'm watching the $95 to $100 zone for stabilization, not bounce, but compression. If silver can hold that range and stop making new lows, that would indicate the forced selling is exhausted. Second, I'm watching volatility itself. Does it contract or does it stay erratic? Because erratic volatility means there's still leverage being unwound. Contracting volatility means we're moving toward equilibrium. Third, I'm monitoring physical premiums, especially out of Asia. If paper breaks but physical stays bid, repricing tends to follow. That's when the market's telling you the paper price got disconnected from physical reality. Based on my analysis, this move was mechanical, not emotional, structural, not fundamental. The fundamental picture around silver hasn't changed. You've still got supply constraints. You've still got industrial demand from solar, from EVs, from electronics. You've still got investment demand as a monetary hedge. None of that disappeared in 24 hours. What disappeared was excess leverage. And honestly, that's probably healthy long-term even though it hurts short-term. If history rhymes and silver stabilizes above that $95 to $100 range, the move that follows could be significant. Not because of speculation, because real buyers step in when forced sellers are done. That's how bottoms form. Not with a bang. With exhaustion. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Look at the data yourself. Make your own decisions based on your own risk tolerance and your own time frame. If you made it this far, you're thinking like a market participant, not a spectator. That mentality will serve you well. Share this with someone who needs to understand what just happened. Subscribe if you want more analysis like this. And remember, understanding the mechanics is how you stay ahead of the headlines. Stay sharp out there. Think critically, verify the data, and make your own decisions.